Life insurance policies. We're going to start with term insurance, which is kind of the beginning of all types of life insurance policies. It was kind of the first attempt to write coverage. The simplest, purest form of insurance is term insurance. It's always going to be the cheapest. There is never a cash value on term policies. That's why the premium is lower. Annually renewable term. This is also sometimes referred to as yearly renewable term. It means that every year at the policy date, the end of the policy, if you want the coverage to continue, you have to renew it for another year, and you're now a year older, so your premium goes up. You get to the end of that year, now you're another year older, so your premium is going to go up again because you're a year older. Because age, gender, and smoker, non-smoker are the three big factors in the cost of insurance typically. So it's kind of the first way to start. Term should be considered temporary insurance. Think T for term, T for temporary, because as you can see, every year you get older, your premium is higher. It will get very expensive over time. So one thing to remember also on the term, while you're in that term means a period of time, that year of the policy, the death benefit is level, okay? Every year the premium is what's going to go up. Your death benefit stays the same or is level. There are a couple of other ways that term insurance can be set up. Each one kind of meets a different need. The first one is called increasing term. What is increasing is the death benefit, the face amount, what's going to be paid to your beneficiary. The premium is the same, but your death benefit is increasing. Typically, this is used as a rider. You add it to another policy to get a bump in the death benefit for a few years. That's the whole purpose of them. So it's called increasing term. What increases during that term period? The death benefit. Could be a test question. The next type of term insurance, kind of a special version, if you will, is called level term. For a period of time, and you choose the period of time. It can be a 5, 10, 15, 20, or even 30-year level term. It means that the premium stays level as well as the death benefit for that period of time. So the death benefit is the same, the premium is the same. Let's say you do, it would be called a 10-year level premium. It's exactly that. The premium, instead of going up every year like stair steps, is going to be level for that period of time. 10 years, 20 years, 30 years. Also, the premium on this product stays level. Decreasing term is another type of term insurance. Again, the premium stays level, but the death benefit decreases. It goes down. And it's used for a very specific reason. Think debt. Decreasing term starts with a D. Debt starts with a D. It'll help you remember it. If you owe somebody money, every time you make a payment on a loan or whatever, the loan amount comes down. Well, decreasing term, the face amount, the death benefit of the policy exactly matches what you still owe on the loan. So you make a payment, the loan amount that you owe goes down, the death benefit goes down and matches it, exactly. So what happens if you die while you still have that outstanding loan? Outstanding means you still owe it to someone, and you pass away and you had this decreasing term policy in place, the death benefit would be paid to the entity that had loaned you that money, and it would pay off that debt so the loved ones you leave behind would not have to worry about it. So it's a very specific use for the term insurance. It is to cover a debt while you still owe a lender money on your loan that you haven't paid off. Just remember, it's D for debt. It is decreasing term. The face amount decreases, the premium stays level, and it matches what you owe on the loan. Once the loan is paid off and that balance is zero, your policy would be down to zero and it would be done, just like your loan is now done because you paid it off. Let's give a recap on term insurance. The basics. Term equals temporary. They both start with the T. It gets too expensive over time to keep for long periods of time, so it's said to be temporary coverage. It is always going to be the least expensive, at least initially, because you're not putting extra premium dollars in that goes into the cash value. There's never a cash value on term insurance. Therefore, you can never have a loan on a term policy because it's a loan against cash value. You have no cash value, therefore you can't take any loans. There's nothing to loan it from, right? So no loans on term insurance, and it is said to mature at death, meaning it will pay out to your beneficiary if you die. There are basically three types or structure to term policies. One is the level term. One is increasing, that's the one that's used as a rider typically, and then there's decreasing term that is used to cover a debt. As your debt gets paid off and the value of that loan goes down, your death benefit matches exactly what you owe. Every time you make a payment, the amount that you owe is less, the death benefit drops and always mirrors what you still owe on your loan. The features that are offered sometimes on term, there's not a whole lot. Again, this is pretty simplified coverage. So on term, you can have a renewable feature, which means you get to the end of the term or the period of time you've had the first amount of coverage. If it's renewable, you would be able or allowed to go ahead and renew for another period of time. If it's that annual renewable term, again, it's going to cost you more every year. As you get to be a year older, your premium is going to go up accordingly. And then there's a convertible feature, which is not a bad thing because a lot of people start out purchasing term insurance because it is initially the cheapest. So it's a way to get people into insurance. And then if you have a product that you sell them, a term product that has a convertibility feature on it, it means they would in the future at some point be able to convert the term insurance to some other type of cash accruing policy later on. So it's a great way to kind of do some planning, and help them say, okay, let's get you your coverage today. Let's use term because it's cheaper right now. And then as your income is better or as your expenses drop, then maybe we can get you into a policy that's going to maybe have a little bit higher premium, but it'll have some cash value accrual, which is always a great feature for many people to think about. So the convertible feature could come in very handy for certain customers. So the general uses for insurance, it gets you the maximum coverage for the least amount of premium cost initially. Increasing term is used as the riders. Decreasing term is used to pay down your debts. As you pay down the debt, your death benefit matches what the new balance is that you owe on the debt. As it decreases, the life insurance decreases as well, till you pay off the loan and the policy is now done as well. This is a good example of a typical whole life insurance policy. You can see that the death benefit is level. It's $100,000 in this example. It also shows you start out at whatever age you are when you take it out. Let's say you were 30 when you took out this policy. It's a whole life policy, so it's permanent. What is it going to pay out to? What age? Always whole life goes out to age 100 unless you have something different in your specific state. But understand it's going to be age 100. So if you take it out at age 30 and say you pay a premium every single year, you would have paid 70 premiums in, right? Started at age 30. 30 minus 100 is 70. You'd have 70 years of paying premium in. Cash value started accruing about year 3, and then out at age 100, that cash value is going to equal your death benefit, and again, it would be paid out to you because you're still alive at age 100. It is said to endow or mature. Single premium payments. Again, we're talking about a whole life insurance policy. It's permanent. It's going to go all the way out to age 100, and it will accrue or grow a cash value over time. There's a particular situation where you will have immediate cash value on a whole life policy, and that's if you make a large single premium or one-time premium payment into that policy. So if you're 30 and you're taking out this policy that's going to go all the way to age 100 because that's when it matures, you would have had to pay 70 premium payments over each, one payment every year. Or you could take a big lump sum of cash if you had it and pay all the premium up immediately in the very beginning when you take the policy, when you first take out the policy. You would do a large lump sum payment, one-time premium, and because you're putting a lot more money in up front than you need to cover the mortality charges, where does all that excess money go? It goes into the cash value. That's why on a single premium, whole life policy, you're going to have immediate cash value because you're overpaying the premium. You're putting 70 years worth of premium, for example, if you bought it at age 30, you're putting it in all at one time. So that excess money goes into the cash value and gives you an immediate cash value. So you can make a single premium payment on a life insurance policy. You make one large lump sum, pay it up completely, and then you don't have to worry about any more premium payments. It's a whole life policy. You're going to have that death benefit in place all the way out to age 100 and just make one large upfront payment in the very beginning of the policy. Then there's another way that you can pay into a whole life policy. It's called a form of limited pay. Sometimes it's listed as LP and then it'll have a number like LP 65. The LP stands for limited pay. It means that you are going to pay the premium completely up for the whole life of the policy, but you're going to have it completely paid up at age 65. LP, limited pay to age 65. Why would somebody want to do a limited payment? Well, think about it. It's a whole life policy. It's going to cover you, your death, all the way up to age 100, and you're just getting the premium in faster. Why would maybe someone choose age 65? It's a typical retirement age. You're going to go on a fixed income. So you might want to get the policy paid up while you're still working, so you don't have to then worry about any premium coming due after you go on to your more fixed retirement income, and yet you've got the coverage all the way out to age 100. So there's lots of different ways to structure the premium payments to get it into the policy, whatever's going to work best for your client. There is another way you can look at limited pays also. I mentioned LP 65 to a certain age. You can also just do a limited pay, say a 30-year limited pay. It just means that if you chose 30 years, you'd pay premium for 30 years, but you'd be paying more premium than if you paid a premium individually for all 70 years in the example that I've used in the past. So if you start at 30 and you do a 30 pay, that means you would pay to age 60. And you would have paid more premium than a regular straight annual premium that you have to make every year out to age 100. Again, it's more of a budgeting kind of thing. What works for your customer? They may have a certain number of years that they want to get that premium done and in, but know that they will have that death benefit in place all the way out to age 100. So it's a limited pay, or either by an age or a limited pay by a number of years that the client chooses. Another way to pay premium is what is called straight life. It means that you make a premium payment every year on a whole life policy. Let's say you're 30 when you take out the policy, so you're going to make a premium payment every single year for 70 years because age 30 plus 70 more years gets you to age 100 when that policy is going to mature and pay out. So that's called straight life. You're making a payment in a straight line every single year until the policy reaches maturity. Comparison of term versus whole life. Okay? Term is temporary, never has a cash value. It's always going to be initially cheaper in the early years. And also it is always for a certain period of time because that's what term means. Term stands for or means a period of time. Now, a whole life policy is considered permanent. It's going to go out to age 100. It is going to give you lifetime protection because it goes out to age 100. It does have a cash value side to it. And if you're the owner of the policy, you can access those cash values during your lifetime. You can do a loan against the cash values. So different products for different people, whatever the needs of your client are. We're going to talk for a moment about life insurance that is referred to as adjustable life. It's a form of a flexible type policy. They were came after the whole life policies in the evolution of these different products. You can, with adjustable life, it can be a term type of policy or permanent. So that's flexible right there. It could be either one, right? Okay, the policy owner can adjust a couple of the features of the policy. For example, the premium amount or the premium payment period can be changed as needed. You can even lower the face amount, for example. You can change the coverage period, how long you've got the coverage, how many years out is it going to cover you all the way to age 100? Are you going to, be a little bit shorter than that? Why would somebody want to have this flexibility to a policy? This kind of product, this flexible product, is really good for persons like yourself as an agent. You might have some really good months or years, and then you might have some lean years, and you can adjust the premium amount, even the face amount, the death benefit amount that you're paying for, and it helps you to keep the product in place but change it so you can afford to still keep paying the premiums to keep the coverage for you. So that flexibility is great for people who have incomes that are unpredictable, people that work on commission. Realtors would fall in the same category. So anybody that's uncertain of income, in the future years, an adjustable policy might be just the answer for them. Universal life. Universal life is sometimes called interest sensitive whole life. It just depends. It basically means the same thing. It just has two different names. It's one of those situations where two names mean the same thing. Universal life has a stated interest rate, which is what grows the cash value, and that is stated for 1 year at a time. Every year when the policy renews, the insurance company is going to look at the interest rate that their universal policy is paying you, and they're going to look and see what the prevailing interest rates are out in the marketplace, what are loan rates, what are interest rates at banks, things like that. So if the interest rates are higher now, they may offer you a higher interest rate for the next year. So they do change. If, say, interest rates have dropped, between the time you took this rate last year and now rates are lower, they're going to offer you a lower interest rate now. That's how it works. Now, universal policies now do have kind of a bottom. They have a minimum interest rate, for example, 1 to 2%. So if interest rates really dropped very, very low, at least your policy would make 1 or 2% interest, and your cash values would still be growing a little bit. So it's a little bit of protection for the insured. But the annual rate is literally reviewed and changed according to the rates at the time it comes up for renewal every year. So it's kind of unique. It is unique to universal life. The monies from the premium dollars, the excess money goes into the cash value, and the interest, that rate that they're applying for 1 year, is used to grow that cash value. Out of those cash values, the company can take their expenses, the cost of, the covering the mortality charges and the overhead and things like that. And then you as the insured could take loans and or withdrawals from the cash value. So it's just a kind of a different structure. On the whole life policies, they also use an interest rate, but it's a fixed guaranteed interest rate that never changes. That's the big difference between whole life and interest sensitive. The interest rate changes every year on interest sensitive whole life or universal life. A form of universal life is sometimes referred to as flexible premium adjustable life. So the insured can skip a premium payment as long as there's more money in the cash value than what your premium payment is that's due right now. So let's say you have a cash value of $400 and your premium that is due is $100. Well, you've got more money than the premium amount, so you could literally say, I'm not going to physically write a check and hand it to the insurance company. I want you to just take my premium payment out of my cash value. You can do that. Again, these flexible policies can really meet the needs of a lot of people, especially people with varying income. So it's a good thing that they can do that. So the cash values, always have to be more, of course, than what you need to cover your premium. If not, you wouldn't be able to say, take it out of the cash values. But it is nice to have that flexibility. You literally can skip writing a check and just have them take it out of the cash value. Great feature of that flexible premium, adjustable life insurance. Universal life insurance, option A or option B. First of all, universal life are the only policies that have option A or option B. So if you have a test question asking you about option A, option B, you just remember the answer has to be some type of universal life insurance policy. So that's a clue right there. Okay, so with option A, you get a level death benefit. You can see the chart shows that the death benefit, when you first start out in the early years, there's a certain amount of death benefit there and it is level, and then it reaches a point where the death benefit starts to go up as the cash value is growing. Because remember, you don't want the two to equal until age 100, because these are still permanent policies. They all go out to age 100. But if you look at option B, you have a decreasing from the beginning, usually starting out at less than what the death benefit would be on option A, but it increases gradually over time, and you can see the cash value grows, more slowly because of that. So it's just a difference of, how you want the policy to perform or what you want it to do. Typically, generally, the option A has a cheaper premium. Sometimes the option B can be quite expensive, so people often like the idea of this increasing death benefit. But then when they see the cost of the premium, they go back and take option A. But it's going to be totally whatever is going to work best for the client. So it's nice to have that flexibility. We have talked a lot about individual insurance policies. That's what everything we've covered has been about. But there is another way to acquire insurance, and it's through a group. Some neat features about group, and the reason many people like to join certain groups is because it gives them the ability to get relatively inexpensive death benefit. Now, you have to remember there's a couple of major rules that have to be followed. First of all, a group cannot be formed for the sole reason of let's all join together and go buy insurance. The group has to have another reason to exist, not to buy insurance, right? So one of the biggest groups, the group that most often does this, is the employer-employee group. Have you ever had a death benefit, insurance provided as like a fringe benefit through work? It's very common. So again, your group is formed because you're employees of your employer, so that's your reason to exist, and then as a fringe benefit of that, you're able to take advantage of group life insurance. So the employer, if it's an employer-employee kind of situation, the employer sits down with the insurance company and kind of figures out how they want to structure it. Typically, group life insurance through your employer is going to be term insurance because it is the cheapest form. So usually it's term insurance. And they'll decide, well, are we going to let them cover their spouses? Will we let them cover their kids? That type of thing. And the employer makes that decision with the insurance company. And then the employer maintains what is called the master policy. There's only one policy that covers everybody, and the employer kind of hangs on to that. And then each of you as an employee are given a certificate of insurance. It's proof, it's like a one-page document, and it's proof that you have the coverage. It'll tell the insurance company's name, usually your employer name. You'll be listed as the employee. death benefit will be listed, and then if you're allowed to cover your spouse or kids, they would be listed and the dollar amounts that you can cover them for. So it would all be on one page, so it's proof that you do have that coverage. But you do not get the policy. The master policy is in the hands of the employer. You get your certificate of insurance. You have group underwriting applied, which is very, very liberal. Okay, you're an employee of this employer who's offering this group life insurance as a benefit. The theory with the insurance company and the actuaries, the underwriters, they go, you know, if you are at work, you're well enough to be at work, we're going to assume you're well enough, you know, to be part of this group, and we'll cover you. So they can't go to any one person in the group and say, we're not going to cover you, you're too sick. Can't do it. That's the nice thing about group coverage. It sometimes is the only way some people who maybe have health problems are allowed to get some life insurance. So it's a great, great feature, you know, if they're able to do that. So group underwriting is very, very liberal. It's pretty much non-existent because they consider you, you know, you're well enough to work. Now, you do have to meet eligibility. Usually the biggest eligibility thing on these kinds of things through the employer is you have to be a full-time employee versus a part-time employee. Usually there's some kind of eligibility requirement that has to be met. And what are some eligible groups? We've talked about the employer-employee. That's usually the biggest, the most popular. You can have that debtor-creditor, that credit insurance that we talked about. If you have a loan, they can say, would you like to take out credit life? So if you die early, your loan's going to be covered and the death benefit will pay out to the person you owe the money to. That's another group. Labor unions can offer insurance to their members, and also certain associations will offer life insurance. For example, AARP or the AAA, they offer group life insurance to members of their association. So again, it's another way. Sometimes if you're looking for some cheaper insurance, if you can become a valid member of a certain type of group or association, and if they're offering, you know, a death benefit, for example, a life insurance policy, it's a great way for you to get it. You just have to join the right group. Let's talk about group conversion. So you've been at this employer, you're getting your group life insurance, it's term, it's great, but now you're leaving the group, you're leaving the employer. What happens? Well, there's a couple things that have to happen. First of all, you have to have been covered under the group plan for at least 5 years. So let's say you meet that requirement. Well, then you can have the ability to convert. If you do convert, you have to go to some type of whole life policy. They will not let you convert a group term policy into an individual term policy. It has to be some type of cash value policy, okay, whole life. So that's one thing. One other thing is you have to do the conversion within 31 days, and you do not have to show proof of insurability, meaning that you don't have to go through a physical as long as you do the conversion within that 31-day period. Now, think about this. You're going from group to individual. That right there should indicate to you that the premiums are going to what? Go up, stay the same, or go down? They're going to go up because you're going from group, which is always cheaper than individual, right? And you have to go from your term policy and you have to go into some type of whole life policy, cash value. Premiums are going to be higher. So it makes two reasons why a conversion is always going to be higher premiums, because you're going to individual and you're going from term to some type of whole life. So that policy is always going to cost you more as an individual. That is oftentimes the reason why people don't do the conversion, is because of the cost. They just simply can't afford it. Variable life insurance. Variable life insurance was created to take advantage of a very high stock market. Everything was booming. You couldn't pick a bad stock. Everybody was just really successful. If you were exposed to the stock market, you had purchases out that, you know, gave you this growth. The stock market was just growing by leaps and bounds. So the insurance industry said, you know, we could make an insurance product that we could take advantage of this really great market that's happening. So they created variable products. So this variable product is very unique because it is a life insurance product, so you have to have your life insurance license in your state to sell it. And you also have to have a securities license because of what makes the cash value grow in this policy is actually the performance of the separate account, which is mutual funds. So you have to have life insurance licensing, and you must have, at minimum, a securities registration, a Series 6 and 63, both of them, or you cannot sell this product, okay? Because you are selling mutual funds which are acquired through the separate account. One of the giveaways, that's a reason or a way you can tell if you're dealing with a variable product, they always use the term separate account. Separate accounts is where the cash value money goes, and then you, the owner of the policy, choose which mutual funds, based on those that are offered for that particular product. You get to pick and choose, and you can change them every month, the various mutual funds. So you kind of have more control over your investment because it actually is an investment because you have stock market exposure. So again, you have to have your securities registrations and your life insurance license. So you're double compliance. You have to follow insurance law, and you must follow SEC FINRA rules and regulations, which is all concerning the stock market. Also, because of the variableness, what varies? The stock market, right? Every day, your values could change every single day because mutual funds are valued once a day. So your value of your separate account, your cash value, is going to vary based on what the funds are doing. It could be up, it could be down. If the funds are up and they're making money, your cash value is going to be up. If the value in the separate account are falling, it means your mutual funds are losing money, and that impacts your cash value. It's going to drop as well. So these are a riskier product, but in investments, risk and reward, it's a balance between the two. It's the same thing here. If you have clients who have a higher risk tolerance, they can handle the fact that their account is going to go up and down and they're okay with it, then they're a good choice probably for some type of a variable policy. But if you've got a client that goes, oh no, I've never ever gotten into the stock market, I'm too afraid of it, I don't trust it, I can't lose any of this money, I just can't do it, you would not ever put them in a variable life insurance policy because you can't expose them to a risk they can't tolerate, they can't handle. Okay, so on variable products, you always have to ask a lot more questions and figure out their risk tolerance and what it is they're trying to do with this money and the cash value. So you have to pay more attention and do a little bit more digging to make sure that you're matching the client up with the right product. Variable universal life is, if you will think of it this way, it's a hybrid. It has features of variable life insurance, and it has features of the universal life policy. So it's kind of a combination of both of them. It is also regulated by both the insurance department in your state and the SEC FINRA because, again, it has some features of the variable. So you're going to have your securities registrations, minimum of 6 and 63, as well as your state life insurance license to sell these. So agents have to be registered with FINRA, have their securities registrations and their life insurance licensing. It has a lot of features of whole life, so it's whole life, it's permanent, it's going out to age 100, right? Death benefit's going to be there as long as the premium's paid. The investment component is through those separate accounts, so they're getting that from the variable side. And you can have a flexible premium though. Maybe you skip a premium, take it out of the cash value, that type of thing. That's a component from the universal life side. So it's a combination of the two. Let's do a recap a bit on whole life. Whole life has a guaranteed death benefit, goes all the way out to age 100. Also, you have what are called the living benefits, the ability to take a loan against the cash values, right? Cash value is going to accrue by a guaranteed interest rate paid to you by the insurance company. So they may say, okay, we're going to give you a guaranteed 6% interest rate on this policy every single year. So you pay your premium into the insurance company. They take out enough of the premium to cover the mortality cost, the death benefit. The excess money goes actually into what is called the general account of the insurance company. Then they have their own investment specialists who go out and take everybody's monies that are in their cash values for these fixed, permanent, whole life products, and they go out into the marketplace and get the money invested because they've promised you 6% interest. They have to make 6%, right? What if they go out and they make 10% on the money? Well, they've got the 6% they need to grow your cash value in your policy, and there's 4% left over. The insurance company keeps that. They make money on your money. That's how it works. Thing to remember too for a possible test question, because on a whole life policy, it doesn't have separate accounts. It's just got the general account of the insurance company, and they have their investment specialists get it invested, right? Okay, so that is, there's a term that they use, or a question that they use, and the question is, who bears the investment risk on a whole life policy? What that term means, who bears the investment risk, it means who's doing the investing, who's making the choices, who's getting that, making sure you get your 6% interest rate. It's the insurance company, the insurer, because they're responsible for taking care of it. They guaranteed you an interest rate. So you could see that test question. If it's whole life insurance, it's always the insurance company who's making those investment choices to get you that guaranteed interest rate. Variable life insurance. This is a little different. It's an investment-based product. Those separate accounts, which you get to choose which mutual funds you want to invest the cash values in. That's different from whole life. So the cash value is in the separate accounts. That's a key word. If you've got a question about separate accounts, again, it's going to have an answer that relates to a variable product. Cash value fluctuates with the performance of the portfolio of the funds, and it can vary from day to day. They are not for everybody. If you've got someone who cannot tolerate, is scared to death of the stock market, you do not put them in a variable product because it would not be an appropriate choice. Let me give you a question you might have on a variable. Variable life. Who bears the investment risk on a variable product? Who bears the investment risk? Who's responsible? Who gets to make the choices where the money is being invested in the separate account? The insured. You make the choice, right? The money goes into the separate account and you decide on those mutual funds that you want. So you have control of the investment choices, you the insured. That's very unique to variable products. Annuity basics. One of the reasons that a person might be interested in purchasing an annuity is to protect themselves against the possibility of outliving their money. Always something to be considered. It provides income for a specified period of time or for as long as you live, depending upon how you structure the annuity. Payments until the death of the annuitant is usually the case, again, depending what option or choices that you have. And it's one of the reasons people like to use annuities for that reason. You can structure payouts to yourself that will never go away for as long as you live. So it's a great product. It has a good fit for many, many people, lots of different uses. Let's compare it a little bit, though, with life insurance, because both life insurance and annuities are products of a life insurance company, and they are diametrically opposite. So on a life insurance policy, you are covering the risk that you might die prematurely, die too soon, and you're trying to maybe protect the loved ones that you're leaving behind. That death benefit, when it pays out to the named beneficiary, is paid federal income tax free to the beneficiary, and it creates an immediate estate. To have an estate simply means that you now have assets, and a large lump sum payment of a death benefit creates a big asset or an estate. Death benefits pays at the time the insured passes away, Every life insurance policy has a named or designated beneficiary who receives the proceeds upon the death of the insured. Now, annuities cover the risk of living too long. You can structure them so regardless if you live to be 110, you can still be receiving payments depending upon choices that you make. It's a wonderful, wonderful feature of annuities. You can use an annuity to liquidate an estate, to spend down that asset, the income that you have. It pays an annuity benefit to you, the annuitant, if you annuitize. Sometimes it's referred to as the living benefit because you've put money into the annuity as the owner during the accumulation period, and now you annuitize, and you are turning on an income stream to yourself. So you're receiving those benefits while you live. Let's talk about the parties to an annuity. If you have a person who is described as the owner of the annuity, by calling that person the owner, it's telling you that the person is putting money into the annuity, not taking money out of the annuity. Because when you annuitize, which by the way is the correct way to take money out of an annuity, you are then referred to as the annuitant. So if you're called the owner on a test question, it means that you own the policy, you own the annuity, you're putting money into it, and so you're in the savings or accumulation phase of the annuity. If they refer to you as the annuitant, it means you have started taking money out of the annuity. You are paying yourself an income from the annuity. So you are called the annuitant. When you are in the accumulation period, you always have a named beneficiary. If you, the owner, should pass away while you're still having money put into the annuity or it's growing, the insurance company could not keep that money if you were to pass away. So you always have a named beneficiary. If you pass away and you're still in that accumulation period, the insurance company will contact the beneficiary and find out how they would like to proceed with this annuity contract. In the annuitization period, you always are doing it the right way. You're turning on that income stream coming to yourself. You never have to annuitize, though. It is not a requirement of an annuity. Many customers may come to you thinking that they have to at some point start taking money out, but you don't. One of the reasons people love to buy annuities is the deferred growth. They put their nest egg or their rainy day money in the annuity and they never plan to take it out. They want it there just as a fallback, just in case. So you do not have to annuitize unless you want to turn an income stream on for yourself. Here's just a different kind of view or way to imagine an annuity in your mind. You can see how the money is starting to grow over a period of time that you're in that accumulation period. It's either growing by the money you're putting in or it's growing because of the fixed interest rate or the performance of those separate accounts, which are the mutual funds if it's a variable product. And then if you reach a point where you feel that you now want to have an income coming to you from the annuity, you go into that next phase. That's the annuitization phase. You turn on that income stream to yourself. And depending upon how you structure that payout, you can never outlive the payment. Great feature of an annuity. Let's talk about a fixed period or fixed amount choice when you annuitize. So, obviously a fixed period means a fixed period of time, and you decide that you want your payout, you annuitize, you're going from the accumulation period to the annuitization phase because now you're turning on an income stream, and you choose the fixed period of 6 years, 10 years, 12 years, whatever you need. You customize how many years you want to get the payment. Remember, this is not something that is based on your life expectancy. You are picking a number of years that you want. You can outlive that payment. What if you chose a payment of 6 years? Year 7 starts, you're still alive. You won't have any more money coming to you. Everything would have been paid out from the annuity because you chose a 6-year fixed period of time. You can always outlive a fixed period of time choice as a payout. Also, a fixed amount. You could say, all right, every year I want you to pay me $20,000 out of my annuity. And they will pay that to you until the money is gone. Depending upon how much money you have to work with, how old you are, how your health is, you could outlive those payments as well. So fixed amount as well as the fixed period of time. You can outlive that, you could still be alive, and then you would have no income coming to you from the annuity. Did you know that on an annuity, you can take an annuity out as a single person, individual, or multiple people can buy one annuity as well. Depends on the product, depends on the company. But just understand you can do it either single or multiple people covered on the same annuity. Very similar to how you can buy certain types of life insurance policies the same way as an individual or several people.